I was talking to a small child the other day, and it struck me that this is the way to try and explain and discuss important things. Because if you can't explain a big issue to a small 7-year-old, you don't really know what you're talking about. So imagine your friend borrows lots of money to buy toys and then lends some of that money to other friends who promise to pay back later. Then they lend to more friends and everyone keeps promising to pay everyone else back. It works fine until one friend can't pay, then suddenly no one can. It's a sort of pyramid. And that's a bit like what's happened before in the 2008 crash, when big banks lent too much and hid the risk by slicing and dicing loans into neat-looking boxes that seemed safe but weren't. Now, in 2025, this year, the grown-ups are worried the same game is happening again. Not with houses, but with companies. Two American companies, First Brands, which made car parts, and Tricolor, which gave car loans to people with bad credit, borrowed lots of money from private credit funds, and these funds aren't big banks, but private groups of investors who lend money in riskier ways. When those two companies failed, it was like two big blocks in a tower suddenly falling out. Andrew Bailey, the man in charge of the Bank of England, said this feels familiar. He hears alarm bells, according to the Financial Times, because risky lending and clever packaging of debt, slicing and dicing, often look fine until suddenly they don't. So Bailey is warning, if one or two companies are collapsing, maybe it's a sign of a bigger problem hiding underneath. So the historical context of this is the echo of what happened in 2008. In 2008, Wall Street created beautiful-looking financial products built on rotten foundations. Banks took risky subprime mortgages, bundled them into asset-backed securities, and sold them worldwide. Everyone believed the bundles were safe because ratings agencies gave them AAA labels. And when the US house prices fell, those securities collapsed, freezing global credit markets and causing the worst recession since the 1930s. Andrew Bailey was a regulator then, and he remembers the complacency. Everyone said it's too small to be a problem. It wasn't. The crash showed how small failures can spread through a web of hidden connections. The current situation, this rise of private credit, after 2008, governments made banks safer, but lending didn't stop. It moved elsewhere. Private credit funds, often backed by hedge funds, insurers, or pension money, began lending directly to companies. They're now worth $2 trillion globally and are far less regulated. Why? Because private credit offers higher returns in a world where normal interest rates were near zero for years. But as rates rose sharply in 2022 to 2024, the cost of servicing those debts exploded. Some borrowers can't keep up. Now, I think part of this is the over-regulation of the banks to the point where the banks aren't doing the job that is needed by companies and by individuals. So this other group have come in to fill that hole, and they don't do it very well. First Brands borrowed against its invoices, that's money customers owed it. Tricolor bundled up car loans from risky borrowers and sold them to investors, much like subprime mortgages were once sold. When they failed, it revealed how fragile these structures can be. The IMF recently warned that banks and funds together have $4.5 trillion tied up in private credit. If that market cracks, losses could spread quickly across global finance, and Bailey is quite right to worry about contagion, a domino effect where one collapse triggers another. So you have to ask, are his fears realistic? Not entirely, but they are reasonable. There are arguments for concern and there are arguments against panic. First, the arguments for concern. The private credit is often unregulated and secretive. Investors can't always see what's inside those loan bundles. Funds borrow to lend, multiplying the effect of any failure. And rating agencies have often given high grades AAA to risky debt, a déjà vu from 2008. So basically, they are guilty of overconfidence. There's a liquidity risk. When investors try to withdraw, funds may be unable to sell their assets fast enough. The arguments against the panic are that the scale of private credit is smaller than the pre-2008 mortgage markets. Banks are stronger, better capitalized, more tightly supervised. Many private credit funds lend on a smaller company-by-company basis, not vast global chains of derivatives. There is no single too-big-to-fail institution holding all the risk. So, while the parallels with 2008 are clear, the machinery of collapse would likely be slower and more contained. It would hurt investors and some companies, not necessarily trigger a global meltdown. So what can be done? Well, there are five steps that can be taken. First, to ensure more transparency, private credit should not mean private risk. Regulators should require full disclosure of loan structures, ratings and leverage. If you don't know what's inside the box, you shouldn't be allowed to sell it. Secondly, stress testing must take place. Bailey's idea of a system-wide scenario test is essential. Regulators must simulate a shock, a wave of defaults to see who breaks first and how the damage spreads. Thirdly, we need ratings reform. After 2008, we learned how dangerously wrong credit ratings can be. A modern system should require independent verification of the data behind every rating and accountability for errors. 4. Global coordination. In a world where everything is interconnected through the internet, private credit is global. The Bank of England cannot act alone. The IMF, US Federal Reserve and European Central Bank must coordinate monitoring to prevent risks slipping through national gaps. We are already coordinated, we just need to work harder. And finally, number 5, there needs to be better education. Pension funds, charities and universities have been drawn to the high returns of private credit. They must understand high yield equals high risk. The quiet corner of finance is not quiet at all. Private credit began as a sensible alternative when banks grew cautious. But like all financial innovations, it's bred complexity, secrecy, and hubris. Pride comes before a fall. Andrew Bailey's alarm bells are not nostalgia for 2008. They are recognition that human nature repeats itself, that greed is disguised, in this case, as innovation. The lesson is simple. When credit becomes private, risk becomes public again. The time to drain the system, to test it, to demand transparency is before the next shock, not after it. Andrew Bailey's call is right.